Sawadee Krap. Well, thank you so much to K-Bank Private Banking for having us on the show today. And ladies and gentlemen, thank you so much for logging in. It's always a pleasure to have the opportunity to share our views of the world and how we should manage portfolios in the context. So my role today is to review the global economic environment. And there are two strong points I want to make. One is on the recovery and its nature. And the second one is on the key risk, particularly what that environment means for the US Fed policy outlook. So starting about the recovery and obviously continuing to monitor the economic progress, we've shown these sets of indicators before. There are high frequency data analysis where we monitor both supply and demand metrics. And as you can see, we continue to see progress. But an important point I want to make is that the progress in this recovery is not homogeneous, right? It's not everyone, every country, every sector growing at the same time, at the same pace. We're really seeing the rolling nature of the recovery. So this recovery is going in by sequence. First we had China, then we had the US, and we do believe that now will be the turn of Europe to lead the recovery. And perhaps if the vaccination process is successful, tomorrow might be the turn of emerging markets. And as for region, it's also the same for sectors. We had goods and trade leading the recovery up to now, but we were starting to see peak performance when it comes to goods and trade. And now we're going to see sectors take the relay and lead the recovery. So there's really a rolling nature, a sequential approach to that recovery. A quick word on China. Very clearly, we had very strong Chinese economic activity up to now, but the Chinese authorities are starting to be and to roll down some of the stimulus, which means that the very strong level of activity we had in China up to now is, in our view, unlikely to repeat itself in the coming quarters. It doesn't mean that China will slow down massively, but it does mean that the recovery is entering a new stage, and we're unlikely to see such strong growth going ahead. It will be the same for the US as well, right? The US is now reaching close to peak performance, and we do expect the US recovery to continue, but maybe not at such a strong pace. So it's really about Europe now. Finally, the vaccination campaign has accelerated. And an important point about the European recovery is how convenient the European Recovery Fund timing is, right? So at the moment where vaccination allows Europe to reopen, we have the European Recovery Fund that is kicking in. So we have the first bond issuance, common bond issuance in Europe happening in June now. And basically we will have the first disbursement of the funds in July. So that is a very convincing set of elements to start betting on the European recovery and the fact that Europe is about to take the relay from the US and play a bigger role in that recovery. So again, a very convincing number of elements when it comes to the recovery and its rolling nature. Now, what about the risks? Well, obviously a key risk in that recovery remains the pandemic and the fact that, we could see a variant that would be vaccine resistant, and that would bring us back to square one. Thankfully, for now, the vaccines seem efficient against all the variants, even against the Delta variant that we are seeing develop in India and that we are now seeing also some cases in the UK and in Europe. But again, the key remains the vaccination, and the vaccines remain efficient. But we need those vaccines to be distributed fast, because the more the population is vaccinated, the less variants will be able to develop. So we keep a strong view on that reality. Now, another strong risk in the system has perhaps to do with overheating, right? The fact that we're seeing a very strong recovery and the persistence of policy support, particularly on the fiscal side, opens the question to Are we doing too much? Is the recovery too strong? Is there going to be a risk of overheating and inflation? And let me try to answer that question. Very clearly, we are in the transitory camp when it comes to inflation for a couple of reasons. First, if you are afraid of inflation, have a look at what's going on beneath the surface, right? Most of the inflation that we're seeing in the US and in some other places have to do with base effects, right? Typically, what I'm trying to illustrate here is the base effects of the oil price. Remember that the oil price was $30 a barrel 12 months ago. The oil price is now $70 a barrel, above $70 a barrel, and that is having a price impact on headline inflation. But if you focus on the horizontal axis on this chart, you will see that the peak of these base effects is now, right? The months of May and the months of June. So from this summer, we should start to see headline inflation roll over and head towards more sustainable and acceptable levels. A similar argument is that if we were to be in an overheating environment, inflation would be everywhere. And that's not what we're seeing. What I'm trying to illustrate here on this slide is the fact that inflation is only in a very limited number of subcomponents. Typically, on the left-hand side here, you see that inflation is mostly about airline fares, auto parts, hotels, but core sub-indices, as you can see on the right-hand chart, typically rents, are still at cycle low. If we were in an environment of persistent inflation, rents would be close to cycle high, which is not what we're seeing, right? So very important point is that whether it is from base effects or one-off adjustments, we're seeing a lot of transitory price pressure here in the system. And to these arguments, if we were to be in a more persistent inflation environment, inflation would be everywhere, as I've said, when it comes to sectors, but it would be also everywhere when it comes to regions. So looking at this global inflation chart, despite reopening ahead of the others, China and Israel are not showing a regime shift in inflation. We continue to see very normal and usual inflation level, both in Israel and China. So again, an argument to say that there is very little breadth, there is very limited spaces where we truly see inflation, and that fuels our transitory argument when it comes to inflation. Another important argument is the fact that we have supply bottlenecks, but this is transitory in nature, right? We have bottlenecks because we have very low level of inventories. As you can see here, during the crisis, companies didn't want to produce because they had no clue where demand was about to go. So they took from their stock, right? And now we have a very low level of stock in an environment of rising demand. So the only thing that needs to happen is to normalize the level of stock to better match the demand. That will happen in the coming quarters. It takes a bit of time, but there is no capacity, structural capacity issue in the system. We have enough capacity to respond to the demand. And the final argument for which we are in the transitory camp is the labor market in the US. We still have double the unemployment rate that we had before the COVID shock, especially when adjusted for the participation rate. And as you can see on the right-hand side of the chart, there are still 10 million people that haven't recovered their jobs up to now. So that supply of jobs is going to come in the job market in the second half of the year, and that is going to dampen wages and inflation as people start looking for a job again. So what does that mean for the US Federal Reserve? Well, clearly a lot needs to happen before the Fed can normalize policy. You need to see improvement in the jobs market. Then they need to announce tapering, which in our view will happen in the second half of this year, between August and November. We expect the Federal Reserve to say that they will reduce their asset purchases and to tell us how they intend to do that. Then they need to indeed taper, which we believe is going to be a 2022 story. Tapering 120 billion of asset purchase a month takes a lot of time. So that's a 2022 story. So when we take all of this into account, we don't see how the Federal Reserve will be able to raise its policy rate before the first half of 2023, and that is 2 years away. So we continue to have, I would say, a lot of policy support in the system. So to conclude, we continue to see progress in the recovery with a rolling nature of that recovery. Now is the turn to Europe to lead that recovery. Tomorrow might be the emerging market. All this in a context where we continue to see persistence in policy support, both on the fiscal side and the monetary side. It is true, at some point, authorities like in China will have to exit from some of their emergency schemes. We do not believe that that will totally disrupt the recovery. The recovery is strong enough to continue with a bit less policy support. So a context that remains relatively favorable. We want to continue to give the benefit of the doubt to that recovery. So what do we do in such a context? Well, I'm very happy to hand it over to Stéphane. Thank you so much.